multifamily is here to stay. And I know that there's a little bit of a sour taste that sometimes people have right now, and even some things I've eaten that a little bit of a sour taste, right?
Mhm.
But let's say the person was on a 2-year or 3-year loan, and then now the value's down, they're not in a position to be able to refinance.
Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Welcome to our show that's for those of you that work so hard for your money, and you're now ready for your money to start working harder for you right now. You want that freedom of cash flow today where you become work optional. You work because you want to, not because you have to. But most importantly, guys, it's not just about living a rich life or about getting rich. It's about living a rich life, because as you're blessed financially, you have a greater capacity to create a ripple effect and bless the lives of those around you. Thank you for tuning in today, guys. Thank you for being a part of our show. If you have not done so already, if you also follow on social media, any type, whether it's Facebook, Instagram, TikTok, whatever, hey, go follow at Money Ripples. You'll find our stuff there. Love to always keep giving you good, short little bits of information and things like that to help you on your financial freedom journey today. Hey, guys, so I'm bringing back a return guest here, bringing back Randy Lawrence. Now, if you haven't watched some of our previous episodes, Randy started out as a wealth advisor, much like myself back in the day in the early 2000s. And then in the mid 2000s, he sold off that business, got out of it, and then focused more full-time into real estate investing, specifically around multifamily. And I know the big thing that you guys keep asking is, okay, when's the time to actually buy multifamily? When's the best time to actually buy into apartments? Is it a good time now? Do we wait? How do we know? The one thing I respect about Randy is that, one, fully honest, transparent kind of guy. But then two, this guy has a lot of experience, has a lot of discipline when he does his investing. And a lot of the things that he does to be able to find the right deals are the same kind of things you should learn for yourself too. So Randy, welcome to our show.
Awesome. Hey, thank you so much for having me back, Chris. Great to see you, and great to be back here with the Money Ripplers, and look forward to, just making an impact and hopefully providing some good insights for the folks out there today.
Oh, heck yeah. No, I'm super excited for this one because like I said, when I reached out to you, I'm like, I got to get your take on what's going on, because let's be honest, the news is throwing things out left and right. We hear, cries of recession, we hear cries of soft landing or cries of whatever, right?
Yeah.
And of course, when it comes to apartments in the real estate space, it's kind of that time where everybody says that's a bad place to be, right?
Yeah. Yeah, for sure.
And
Well, and
and I've learned in my experience that usually when everybody says something's bad, that's usually when it starts
boom.
to become good, right?
Yeah, for sure. 100%. Yeah, I was just going to say, it's like kind of the old Warren Buffett kind of deal. It's like when there's blood in the streets, so to speak. And I think taking a step back, looking at multifamily, it's like, okay, we have invested in multifamily based off of what I would say is a multi-decade thesis that, there is more of this country becoming rent by necessity, that demand level's going up. Our country is really bifurcated where it's a service-based economy. You have a majority of the jobs that are created are these, $40,000 to $75,000 a year jobs. Majority of those people are probably not going to end up being in home ownership, and just based on the pricing of homes. And so when you think about that, that's an underlying pin of demand for multifamily. Now, what's happened in the last 3 years, we've seen, inflation just skyrocket the fastest it's been in 40 years. Interest rates moved up the fastest they've been in 40 years. And then that's had a direct and immediate impact on commercial real estate, and a lot of multifamily properties that were bought in, call it 2021, even 22, with, floating rate debt or, bridge debt with rate caps. And so a lot of those projects maybe were bought thinly, underwriting maybe not the best, and we talk about some of that. And as a result of that, it put significant pressure on those properties. And then you've seen where, numerous things, whether it's been foreclosures that have taken place or properties that have been in distress as a result of that. And then, that has cascaded, and you see kind of in the news where they talk about, loans maturing and, office here, multifamily here. And so all of these factors combined give that like, oh, maybe multifamily is not good. And, people have had an investment they made with somebody and, either lost their money or maybe they made an investment and that investment's really underperforming because of some of the things we just said, is really created a very negative vibe for many people as it relates to multifamily. That being said, and some of those things no doubt are actual and true and real. That's what's really taken place depending on the market. But when you take a look at the overall demographics, it's there is a continued demand. Even like some of the new construction that just came into the market in the Southeast this past year was virtually all absorbed, which was, there was a little bit of like, oh my gosh, there's going to be this excess supply. And it just shows the relevancy of the need and the demand for affordable housing, or cheaper than what the home price purchases are.
Yeah. Now I know we brought this up on an episode a few months back, but it seems like it can be really confusing for people a lot of times when they see the stress that happened, right? Because we hear about the variable loan rates and things like that that put people in a pinch, and people think, okay, fine, it costs more money, but it's not just the loan rates that go up, because a lot of times the rents should cover that, but it
Mhm.
seems like it's much more than that, right? It's like the value of the property, which we find out apartments is not valued like single family homes, right?
Correct.
Single family homes based on what somebody will pay for it. Here we have things like cap rates, how much risk potential is there, right?
Yep.
Versus, yeah, the interest rates going up. And then all of a sudden you watch the values almost overnight disappear like 15 to 25%, depending on where you are. I
Yeah.
mean, what's kind of what have you seen? Like what kind of
Well, so
happened
there's
there
a
that even shocked you as somebody
yeah,
who's
there's a
experienced
number
this?
of things I think, and you hit the nail on the head too. So like, where like we've bought a property, I can reflect back to one we bought in 22, drove the NOI by about 40% in about 18 months. That's monster. That is killer to the
Yeah.
bone, stellar performance. However you want to describe that, that's a home run kind of performance. Now, normally speaking, and again, not exact figures because deal size changes things, but this was a smaller deal. I think it was probably in the neighborhood of about 13 million and change, but that would have driven the value by about $6 million. I mean, so home
Wow.
run, in terms of, equity and value creation. But because of what you said, is the cap rate went from a 5 to a 6 in the market in Florida. Interest rates went from a 4 to a 9 on a bridge loan, or call it a 4 to a 6.5, 6.75 on a Fannie Freddie, now back down to about 6, maybe a little lower than that now with the 10-year treasury dropping. But as a result of that, instead of creating 6 million in value, it created like 1.5 million in value. So,
Mm.
and that's where people got to understand that there's more of the mechanics of commercial real estate, because it is driven by the numbers. Now, the other thing though that has been gone on in many cases in places is that people that bought a project like that, maybe they didn't implement the business plan like what I described. They didn't drive NOI by 40%. Maybe they drove it by 15.
Mm.
That's not been enough to overcome that juxtaposition of the cap rate moving up. And so their property value actually went down because of that. And so,
Yeah.
the other factor that we saw a lot of times too, when I've looked at different structures or deals, is that people underwrote things that were not necessarily achieved, where they maybe, like in Houston, a lot of what went on there was people bought a C-class apartment and underwrote like valet trash and parking fees for, upfront parking. In a straight up C-class apartment, people aren't paying valet trash and parking fees. You know what I mean? And
Mhm.
or they underwrote, hey, we're going to get 1,500 rent, and it's like not in that market. You know what I mean? It's just not
Mhm.
doable. And so those factors combined ended up being where instead of getting that NOI from here to there, NOI only went to here, and then the cap rate expanded by a point or more depending on the market. And every market's a little different based on the supply and demand factors. And then that caused that value to go down. And then now what happens also there from a distress standpoint of view is, let's say the person was on a 2-year or 3-year loan, and then now the value's down, they're not in a position to be able to refinance. Or if they did refinance, they'd have to bring a large chunk of money to the table, and they weren't able to do so. And then so now the only real equation was they had to sell the property, and that's where they had to sell it for maybe 20% less than they bought it. Um,
This is almost like 2008, 2009, but instead of single family homes, is now happening in apartments, right? Because you're like, don't have enough equity, that, like you said, if the NOI wasn't quite right or whatever it might be, there's not enough equity for the banks to say, yeah, I'll refinance that, because they want equity in that property, usually at least 20+% before they'll even give you a
Yeah.
refinance, right?
Yeah, and some guys, their business plan was going to do a takeout refi with a 75-80% loan from Fannie Freddie. And that's
Yeah.
not the case right now. The case right now is like 65-68 probably on your best
Oof.
day based on interest rate and DSCR coverage ratios.
Yeah.
So, it's important to know, like, when you're going into an investment, the conservative nature of the underwriting. We've shared through our email and sending out to our group and all that stuff like that. Like, properties we bought in 21 and then sold in 23 for a profit because, we bought it at a good number and, we had those conservative factors in place. So we were genuinely in a time when it's still been a difficult interest rate environment to be able to execute, get the income up where it needs to be, and then still sell at a profit. But we also bought at a good number when we bought it. You know what I mean? And so that's,
Yeah.
real estate is, kind of the old adage, you make your money when you buy. It's like,
Hmm.
there's truth to that. And, the other thing I think that served us well, that again, these are, and as I say these things, I want the audience to, you can be looking for them on the other side, like in the overall marketplace. Like, I'm telling you stuff we do that's best practice. You can look for it and say, is that happening in this deal I'm looking at?
Yeah.
We would always be certain to be the settler and never the pioneer. So like when I'm looking at this deal and I'm saying, hey, we're going to get 1350 rent, there's already 3 people getting 1350 rent in the market right down the road from me. I'm
Hmm.
not guessing that I'm hoping for 1700 and maybe I
Hmm.
get it, maybe I don't. I know I can get 1350 if I do the work to improve the property, make it nicer, update the unit, that kind of thing.
Hmm.
Um, and so I think it's critical to look at those underwriting pieces, because right now that's what we see happening in the marketplace. Maybe some of these misalignments that were there are now coming to fruition in the form of properties that have to sell and the pricing structure is lower than what it was. Now, that being said, we sold 6 deals last year because we'd reached the business plan and we were able to sell profitably. And we were off probably 10 to 12% from the high from a couple of years ago. But I mean, I'm more pragmatic. It's like we were making money selling. So like that's a win for our investors and a win for us.
Yeah.
But now some of the thing that I would say is a little bit different from '08. '08, there was just an avalanche of stuff coming into the marketplace,
Hmm.
in the single family space. I don't really see that. I think the banks have learned their lesson, because properties that are in maybe a little bit of a struggle, the banks are more apt to work together with the person to try to navigate through. It's only when really the person's not working with them or, not participating, then the banks just move ahead and be like, all right, we're going to force sale or foreclose, that kind of thing. So I
Yeah.
think there's more properties that are going to be coming into the marketplace. I don't believe it's just a complete avalanche. I think, there will be, those properties coming in that have to sell because the bank's like, okay, hey, if we're going to extend your loan, you need to bring $2 more million. And then the parties can't bring the $2 more million. So their only option is to sell. And so that
Yeah.
creates opportunity for your listeners and for us. And now it becomes a question, I think, of like Howard Marks. He's written a lot of good books on the stock market and investor psychology, Oak Tree Capital. And it's the pendulum, right? So in 2021, the pendulum was way over here with everybody like, yeah, man, go, go, go.
Hmm.
And now the pendulum is back over here, like where it's like, oh my God, you know what I mean? And realistically, by the end of this year and into next year, the pendulum's probably still over here, but you need to be moving forward because, like, as we look to buy a deal, and we haven't bought a deal in 18 months because we're very conservative, we stick to our numbers, but we've been close. And I'm telling you now, there's going to be some stuff coming on the horizon. And now would be the time to buy because it's like we're going to get a price that's off of what the high was.
Hmm.
Rents are still high. Rents haven't gone down and they're not going down. And then we get a good interest rate on the loan. And then we also have the tailwinds of what would be projected over the next, call it 24 months, is interest rates would decline further, which then
Hmm.
further boost the value of the property. So, you've got
Right.
demand that's still going to be there. You've got a good interest rate environment and you've got what should be a declining interest rate. Interest rates won't go back down to where they were, but they'll go down from where they are. And so,
Yeah.
you know, the
Well,
question really becomes, does the psychology piece, can you as an investor swing from here to here?
right. Well, and like you said, kind of like Warren Buffett says, when there's blood in the streets, that's when he gets greedy. It's when that's when everybody's fearful, he gets greedy. When everybody's greedy, he gets fearful, right? And
Yep,
we've definitely
exactly.
swung the pendulum over the last 3 years
Yeah,
from one extreme to the other for sure.
for sure.
What I want to ask you this before I ask about kind of your buy box, because I know that's the thing
Yeah,
why you say you haven't purchased really much in 18 months. But before I get asked that, I've been hearing a little bit of whisperings lately that banks, although they're still lending, I know there's still money supply there because you see the M2 money supply is, I mean, the feds are pumping out money more now than they were even just
yeah.
earlier this year, which is ironic because they're saying they want to fight inflation, but that's almost like they're trying to pump more money to create more inflation, right? But at the same time, like I've been hearing whisperings that although banks are lending, they're taking a lot longer to process. Are you seeing
Mhm.
that same situation your end too?
Yeah, for sure. I mean, I think that, they're being more meticulous, you know what I mean?
Mm,
More thorough. There's been, and again, same kind of thing, going back here to 2021 kind of thing, you know, they're just going and going and going, man, and slapping
mm,
loans together and moving as quick as they can and just kind of printing money through making loans. And then, a good number of those loans struggle. And so
yeah.
now they're moving in a more meticulous pace to try to check all the boxes. Fannie and Freddie actually just came out with some things where they're going to be a little bit more verification going on with what they want their desk lenders to do because of some of those issues that have happened. And so, and that's also that kind of, think about this, professional people, it's the same pendulum, right? So the
Hmm.
lenders are pendulum swing over here, and they're being a bit more conservative how they look at it, both in the amount that they underwrite to, meaning percentage of loan to value, also in the amount of time that they're spending just digging through the file and vetting and et cetera, et cetera. So,
Yeah,
um,
they're really
but
looking for good, solid deals, aren't they?
yeah, and their preference would be exactly that, to loan on stuff that's better rather than worse. You know what I mean? And so again, if the worse the potential deal, the more they're looking at it in a real fine tooth comb.
And I'm sure it doesn't help that there's layoffs and things like that in the banking industry because I've had clients that have worked in those departments say, yeah, they just laid off a whole ton of people out of our department because as
Yeah.
loans slowed down, they just went, they cleared
Oh,
out.
for sure. Yeah. I mean, that those layoffs have affected them, and then they're slow to hire back. And so that's part of the
Mhm.
equation as well, too. So I mean, there's definitely money that's there for if you've got a good deal, you can get a good loan, reasonably speaking. It's just that, yeah, I mean, it's going to take longer to get through the process, and it's going to be a little bit more, everything's a little bit more of a headache nowadays. Like that's just true. You know what I
Yeah.
mean? Like it's just tougher push dealing with, bureaucrats in a city and permit thing, or dealing with the bank and kind of jumping through their hoops. It really is part of the equation nowadays.
Yeah. Well, speaking of equation, let's talk about your buy box, as you call it, right? Like, what's kind of your criteria for what has to check the boxes for you to want to buy a property? And I think this is valuable because most of our people listening really want to be more passive investors versus just the active investor like you are. But I know a lot of these questions really go work both ways. And
Yeah.
so, what are some of those questions that you use that also they should be considering too when they're looking at getting to someone passively to buy in the apartment space?
Yeah, I mean, so location, location, location is definitely the old adage, right? And it hasn't lost its luster. As an example, we looked at a deal, great basis up in Georgia, offered to us as a distressed property. We're first phone call kind of thing. Hey, we got this property, want to give you opportunity. However, it was, a larger size property, and the area itself was a little bit of not depressed, but there'd been some, it's more got criminal element and stuff like that, and just a harder work, you know what I mean? And so, though the numbers on paper looked good and the price per door looked good, the location wasn't the best for this moment in time, because again, like, especially if you've got economic slowdown or recession, you don't want to have any of that kind of weakness there. And
Mm-hmm.
so, that's important to understand. The other thing I think is when you're looking at it, like, what is your overall, not only the immediate location, but what does your MSA look like? And what does the city look like? is the city growing? Is there jobs coming into the city? Is there demand coming into the city? Are people moving into the city? We've bought in smaller MSAs before that are not high growth, but there were quality diversified job drivers. There was good inflow of people because of those jobs. Not like it's massive, but still good. And
It's growing,
you know,
not dying, right?
yeah, you know what I mean? And then also not, dependent on one thing. It's like, okay, you got
Mhm.
the one plant that's there, and then that plant goes out, and now you got a ghost town, or the one
Right.
military base that's there, and now it's a ghost town,
Not a
and
one horse town. Yeah.
exactly, so that's part of the equation as well. The other thing that you got to look at, and again, now we are also opportunistic. We're looking for opportunity that represents a good buy, and it represents a reduced level of risk with a beneficial or outsized upside return. And so to that end, we're looking at value add. How can we have that? And value add's got a little bit of a negative name to it, but and realistically, it's not. I mean, value add means that I can take this property from where it is today, and by doing certain added additional contributions, meaning construction work, improvements, I'm creating value. I'm manufacturing value. By, like in that other example, driving the NOI by 40%. We did that by renovating units and now bringing the lease rate from 900 to 1350, and that was market for that market. So we're looking for those type of opportunities, and it needs to be that we're not, as I said earlier, driving the overall market. There has to be proof of concept that if 1350 is the rent, other people are getting it. If it's 1250, it's 1250. And then the underwriting that we look at on the deal also is like, what does that look like in terms of positive cash flow in year one? What does that
Mm.
cash on cash look like? Is it positive going out of the gate, or is there a 6-month ramp up? What we've been in this past, 2 years is like, we're not in a window where we wanted to have a neutral cash position. We want to have positive cash out of the gate just because of, the economic uncertainties that we've been facing. So these are a number of the criteria, and I think that you got to look at when, looking at the buy box, and then also, kind of your entry and exit points as well. Like we've seen stuff that look good on paper, but when you're looking at the exit should be, let's say, 140 a door based on the numbers, meaning the income is generated. But then you look at it in that market or that area, nobody's paid close to 140 a door. It's like that causes me a little bit of a pause, because is it real that you can get that? We like to be able to see, okay, in this general market, there's other transactions that have traded for that number. And now we've got kind of proof of concept coming in. We're getting a good price. If we're able to execute the plan, then we should be able to get this price given the criterion that we have and what the market's already shown us.
That's great. No, those are all, I can tell those are all wise things, because I can already think of other, multifamily syndicators, people out there that were raising capital. They were trying to guess the market, right? Try to time the market by being ahead of schedule, right? By trying to get things without the proof of concept. And I can tell what you're looking at is really what's the sure thing, the sure bet. Even if it
Yeah.
means we miss the opportunity, so to speak, right? You're not really
Yeah.
missing the opportunity, because you make sure that people get the return of their money versus just a return on their money.
And that's critical. I mean, we've had, properties that had challenge near Atlanta where evictions had been on hold,
Mm,
God, for up until even this past 6 months, so like 3 years,
wow.
where, that by liberal agenda, they manipulated the laws to still people be delayed on eviction for, 9, 10 months. But
Mm,
because of the things that I just shared with you, we'd had successful results, even
yeah.
though having to surmount some of those difficulties. So I think it's important that your underwriting's got to stay conservative. The buy box meaning is like you got to stay conservative. It's like, and my daughter who works with us, and she's 20, and she's been I mean, good Lord, she started off cleaning the office and cleaning toilets when she was probably 13. You know what I mean? So
Hmm.
she's, been no stranger to it, but she's also on our underwriting team. And we bought, 5 deals that she was the lead underwriter over the years, beginning when she was 16. And but we were able to successfully buy and exit in, like example, like I told you, in 21 and exit in 23 because of that very reason. Like the numbers were proven out. So we were able to execute, even with some of the difficulties we encountered, still were able to execute and still got a reasonable execution on the back end because the numbers were already proof of concept. It wasn't a hope of concept.
I love
And I
that.
think it's important, and so again, when you look at those things, I can tell you tons of decks I saw over the years where the person's targeting 1850 rent,
Mhm.
and like nobody was getting 1850 rent. And even deals we turned down in like Atlanta or other markets where they're pegging this purchase price at, whatever, just, 120 a door. And it's like, well, your exit's got to be 145. For your exit to be 145, the rent's got to be, 1850. There's nobody on the planet that's affording to pay 1850 anytime soon in that marketplace. And so it's
Mhm.
not going to work. And so guys went in and bought that deal that we passed on. And those are also guys that are being like forced to sell and losing money. You know what I mean?
That's
So,
right.
I think it's important that you look at things with an eyes open type approach. And especially, as an LP, you want to make sure that you're seeing these things that we're talking about when you're looking at a prospective deal. Because I see stuff now, and I just did a funny kind of video. It's like deal, 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 deal of a lifetime. You know what I mean? And because
Mhm.
like I've seen like the 15th deal on the internet now on Facebook or whatever, that this is the deal of a lifetime. It's the holy grail. It's a 28% IRR. And I'm like, I could pick that thing apart, man. It's like, you know what I
Mhm.
mean? It's like, the back end is what's, 2/3 of the payday is on the thing, yielding a 27.88% return. And it's like, I would venture to tell you that that's most likely not going to happen, you know?
Exactly. Yep.
But yeah, I think I step back from it though, and I come back to the original, what we started with. Multifamily is here to stay. And I know that
Mhm.
there's a little bit of a sour taste that sometimes people have right now. And even some things I've eaten that's a little bit of a sour taste, right?
Mhm.
But one of my good friends that's been in real estate, he's a real estate attorney, investor, been in the space 40 years. He said a couple of years ago, he's Randy, real estate's absolutely great for 8, but sucks for 2. You know what I mean? And
Mhm.
like there's truth of the cyclical nature of it, right? So we've been
Mhm.
in this 2 to 3 year period of real estate, and commercial real estate has sucked a bit because of the interest rates and the environment we've been in. But it was great for, 10 years preceding. We've gone to 2 to 3 years. We're fixing to move back into that, period of time where I would suggest we're going to see good and great results. And ultimately, we're at a place where this country's not going to change.
Mhm.
Demographically, we're not going back to a majority manufacturing type middle class demographic. It is not going to happen, no matter how you want to slice it. Any repurposing from China's going to India. There's marginal stuff coming back here to the US. And this country will continue to be a service based economy, and it will continue to have an affordable housing need, and it will continue to be in most markets. Like I'm right here in Tampa, go to Atlanta, go to Charlotte. Your starter home in this area here, God of mercy, a 2 bedroom home's $400,000. A guy making 55 and his girlfriend or wife making 50, they can't afford to buy that home.
Mhm.
Period. Period. And so that's a reality that's not going to change. And we will see that picking back up. The question just becomes, are you a part of it, you know, here at the section of the pendulum, or, once everything's going along swimmingly for another 18 or 24 months, people go, oh my God, that's good again. It's like,
Mhm.
well, it was good back here. You know what I mean?
Yeah, exactly. Well, if people want to stay in touch with you, right, to know that timing, especially when you start to see things happen, what's the best way they can follow you or even stay in touch on your email list or whatever it might be?
Yeah, for sure. You can go to our website, www.pcpre.net. Those Prosperity Capital Partners. You can look us up. We're on the web. And we've got a simple button on there. You can just click on it and then join our contact list. And so we'd be able to update you. And then also, I send out weekly videos and commentary on the market, commentary on the 10-year, commentary on life, and wisdom points. But a lot of it's focused on investing, no doubt. So,
Mhm.
definitely would love to have you join with us there. And then also by becoming part of our Insiders Club, you're the first that gets notified when we're, entering into a new transaction, and we tell you that, hey, here's what's going on.
It's great. like you said, the best thing to do is be on the forefront of it, especially when things actually are stable and starting to come back again. So before the emotions catch up to it, right? As you were
Yeah,
saying.
for sure.
So
It is. And, I'm excited about what we have ahead of us. There's definitely been some wood to chop and some wins that we've kind of navigated through on the whole of the commercial real estate side in these last, 24 months, call it.
mhm,
But yet ahead of us, I think no doubt we're going to be looking at a good environment where we have interest rates declining. There's definitely the likelihood there's not going to be an emergency meeting. I know people were talking about that
mhm,
last week. It's like that ain't happening, but it's like there
yeah,
will be rate cuts in September and the possibility, depending on the data, of November and December, which would be phenomenal. I'm not guaranteeing or
mhm,
counting on that, but it'd be phenomenal. And then again, we move into next year, again, assuming with the same points of data, we'll see rate cuts starting again in March. So those are all good things, and it's going to set the tailwinds for the real estate and psychology moving forward. And you already see the Fed's behind the curve because the 10-year, I just looked at it before we jumped on, was at like 385. And so
right.
you've got the Fed at, call it 530. It's like they're already almost a point and a half beyond where the market's at. Because
Mhm.
the bond market is telling you what the real interest rate is today based on supply and demand.
And the feds follow the 10-year treasury, not the other way around, right? So they tend to follow
Exactly.
suit, even if it's
Exactly.
slow and a little bit too late.
For sure. Every time, right? On the front side, they should have raised it sooner and oh, it's transitory. And then now on the backside, they're a point and a half behind where the real rate is. So, but again, I would just say this. I would probably think that the neutral rate's somewhere like 3.25, something like that. So it ain't going down to 0.5%. People
Yeah.
think, oh, rates are going down. It's like they're going to go down, but it ain't going down like that because again, we were at like a 0.5 point neutral rate back in the day. I would probably think it's somewhere around, 275 to 3.25, maybe a smidge higher than that, but it's, that's in that zone. And so, it's reasonable to think and see that we could see, in a year's time from now, rates down in that, that 3% range, that kind of thing on a 10-year.
Mhm.
And again, now that translates, like your Fannie loans at 5%, your bridge loan could be 350 basis points above that,
Mhm.
so if you're down there in that territory, now you're talking a bridge loan at 6.5, 6.75, 7%. That's a good spot. Fannie Freddie down at 5%. Those are good numbers that make for good transactions. I mean, good Lord, we bought plenty of deals where we made money, where a Freddie Mac loan was 5.5. You know what I mean?
Mhm.
And we made good money on it. You know what I mean? So
Right. Well, I know we're kind of out of time, but last quick question for you here. I'm gonna switch gears on you a little bit, but Randy, what do you feel like your ripple effect is?
wow, great question. We have an intention, twofold to impact the folks that invest with us in a positive way. We genuinely want to make a quality impact in their life. We've got some folks that have invested with us for 20 years and impacted 3 generations of their family, which is
Mhm.
it's super exciting because not everybody can be, in the day-to-day minutia and battles of what it takes to operate, real estate on a daily basis. And then the second part of that is at our community level, we're really seeking to make an impact to improve the quality of the life for the folks that are living in our communities, both with making the community itself a better place to live, but also with social improvement programs that we want to implement there and we have implemented, but we're on the process of doing on a whole scale basis, just like with our asset management, property management teams, doing 2 impact events a year at the community, doing where we have financial education training programs at the community, doing where at a certain point in the future, if you've lived in our community for a certain number of years, your kid could be eligible for some type of scholarship stipend. Those are things that are in place and or going to be in place. And so it really is a twofold dynamic where we're making a difference not only in the investors' lives, but in the people's lives that live in our communities. And ultimately that just really creates a greater ripple effect.
That's sort of that win-win-win, right? Yeah, everybody
100%.
prospers and blessed from it.
100%. So
Absolutely.
excited about it and excited about what you guys do too, here with the Ripplers. I mean, it's a great blessing to call you a friend and be a part of the group and just to see the impact that you've made in so many different people's lives and then how that just continues on.
Oh, love it, man. Appreciate having you on today. Everybody, definitely follow Randy, PCPRE. That's Prosperity Capital Partners, RE, like real estate. PCPRE.com. Follow him there.
.net. Oh,
Oh, sorry, .net, not .com,
.net.
.net. Make sure that our team puts that in the show notes so that I don't mess it up.
There you go. It's all good. All right, man. Great seeing you, brother. So fun to be on the show with you.
Same here. Everybody else who's listening, remember, it's not just about being a hearer of the word. It's about being a doer as well, because the doers are when you start to see the real fruits of your faith. Go and make a wonderful, prosperous week. We'll see you later.